Commercial property companies are writing down the value of their assets as higher interest rates put pressure on their finances.
The GFC was a very fast-moving event. This has been, I guess, a slower, more painful, more drawn-out process.
That isn't stopping listed property trust Vital Healthcare from developing more hospitals, but it'll come at a cost to unit holders and tenants.
Operators are going to have to wear more costs, unfortunately for them. We're also going to have to look to adjust our returns.
It's Monday the 17th of July and you're watching Markets with Madison. For a small market, New Zealand has quite a few listed property vehicles, but they're faced with paying more interest on their multi-million-dollar debt positions. And with falling property values, the financing of their growth plans looks uncertain. Commercial property companies listed on the NZX collectively own $20 billion worth of assets, but their debt is in the billions too. With debt repayments increasing and property prices falling, their loan-to-value ratios are on the way up, a measure that could limit their future borrowing capacity and ratings. Their share prices are facing heat too. Listed property has underperformed the NZX Top 50 index for most of the past 12 months. That's despite their properties being filled with tenants. Portfolio occupancy rates are all above 97%. It's worth explaining that the companies all play in different types of property assets: retail, office, industrial and specialised. The biggest of them all, with a portfolio worth almost $5 billion, is Goodman. It owns huge industrial assets across Auckland, including New Zealand Post's flagship mail sorting facility. Property for Industry also focuses on logistics and distribution centres. Precinct Properties is a mainly office developer. It's behind Auckland's Commercial Bay and Wynyard precincts that are reshaping the super city's waterfront. Stride Property also owns office buildings as well as shopping centres. Stride also manages and has a stake in Investor, which specialises in large format retail sites like hardware stores and supermarkets. Kiwi Property Group is big on retail too. It's best known for owning Auckland's Sylvia Park shopping complex. And Argosy, it's a mix of all three, owning retail, office and industrial space. Then there's the niche property trusts like Vital Healthcare. It only deals in healthcare property. It's currently extending this private hospital in Auckland and has acquired more land nearby. But it's just revealed an expected 4.5% decrease in the value of its Trans-Tasman portfolio. Manager of the trust, Hockly, says while its assets are defensive, it's not immune to those higher interest rates. Aaron, thanks so much for your time. Good to see you.
Thank you. Thank you for having me.
You're expecting a $160 million valuation loss for the full year to the end of June. That will bring the total value of your property portfolio down a bit. How much is the commercial property sector hurting right now?
So it takes our valuations down to about $3.5 billion. So we're split 70% Australia, about $2.5 billion in Australia and about $1 billion in New Zealand. So, it is a significant decline. We're not immune to the wider sector declines, which is really a function of rising interest rates affecting fundamental property values. We're not really concerned about it because we're a through the cycle investor. We're really trying to deliver growing returns for our unit holders. Invested in healthcare property and, as I said, through the cycle.
Why do you like healthcare property assets?
So the key reason is really the resilience of the sector and really the uncorrelation with the business cycle. So I think for investors, when they invest in property or invest in a wider group of shares, healthcare property really provides the resilience, the growing returns, and really a defensive asset class compared with other investments.
How does it make it defensive? Is it because your weighted average lease is longer? You're actually one of the highest in the sector, sitting at around 17 years. Is that specifically what makes it defensive?
Yeah, so that is a key component. So if you think about income security that's provided by long-term leases, it's also a factor of during lease terms, typically healthcare operators are responsible for maintenance capex, so you have very low leakage in the returns. But it's also to do with a fundamental resilience of the healthcare sector. We've got ageing and growing populations across Australia and New Zealand, providing increased demand for healthcare. And it's also suffering a lot less technological disruption compared with other sectors, particularly office and retail, where you have different ways of interacting with physical spaces. It's very hard to imagine surgery, for example, being conducted at home in the current environment.
So your occupiers look after maintenance costs. That's pretty great as a landlord, isn't it?
It is good. So the bulk of the maintenance capex is pushed back to operators. That's part of the reason why our leases, the initial yield is relatively lower, because that's all priced in. But it does mean that whatever return we generate, we're able to pay a lot of that back to our unit holders.
I guess a risk though when it comes to healthcare property assets is that they are very well used, right? They're 24/7 used. Do they age faster? Do you worry about the quality and the state of the assets that you're buying?
We do. So part of what we do is ensure that operators are well capitalised and they're regularly investing in the assets. Some of our leases require specific investment, but for the bulk of our healthcare operators, which are the private and the whole, they're very focused on patient outcomes, which result in higher capex, particularly technological upgrades in buildings, but also the look and feel of places. So they are continually investing in the properties that we own.
Now, you mostly own private hospitals, but the public hospital system, those assets are ageing pretty poorly. I know that there is government plans to invest in them quite heavily. What do you make of that investment currently and the pipeline looking forward? Do you think it's at a high enough quality, or do you think it's pretty low and that makes an opportunity for Vital Healthcare to come in with better assets?
So I think it's great to see the greater investment proposed for the public sector and the upgrading of several hospitals that are in badly need of that upgrades. I don't see a direct role for us to play in terms of those hospital upgrades, but what it does mean is that we're more likely to invest in ancillary facilities next door to those upgraded hospitals. So once we see the government upgrading a particular place, that then provides the incentive for us to invest, because we know that surgeons and doctors and nurses are going to be drawn to places with key hospitals, the newer hospitals and the upgraded hospitals. So it provides a better business case from our perspective.
The hospital that we're in currently, there's a development going on next door, and I know that you've recently purchased some land surrounding this place. What are your other acquisition plans, and where specifically are you looking?
Yeah, so we see opportunities across Australia and New Zealand to grow and expand existing assets, but also some new assets, new healthcare facilities in places that have historically been underserved, or places where there's brand new populations that have occurred. So the hospital we're in today, for example, this area didn't exist in Ormiston if you go back 20 years. So we're seeking to expand this facility to respond to that growth in population.
Let's talk about debt just quickly. You have, at my last check, around sort of $1.3 billion worth of debt, and most of that is drawn down bank debt. So do you have enough wiggle room to fulfill all of those hopes and dreams when it comes to acquisitions and developments?
Yeah, that's right. So we've got about $250 million of debt headroom currently. That enables us to pay for the development pipeline over the next 12 months at least. So that's really the debt coverage that we're looking for. We are also seeking to fund part of the development pipeline through asset sales. So we've got about $200 million of assets to be divested over the next few months, some of which have occurred and some of which are in the final stages of being agreed. And that will then allow us to deliver the committed development pipeline, and we'll look at other funding options for either future acquisitions or to fund new developments which we might commit to.
How much should investors expect you to front up on that acquisition and development side, and could you have to raise capital for it?
Look, we've raised capital each of the last 3 years, once a year. It's a bit challenging at the moment where market conditions are, and we're very prudent in terms of when we raise capital, but at some point it's inevitable that we will. I obviously can't give any guidance about when that might be. At the moment we're focused more on selling assets to fund future developments rather than equity raising, and that's a deliberate strategy to really reposition the portfolio into the core healthcare precincts we see best value for our investors for over the long term.
Are you going to need to sell any more assets, or at least charge a higher price for them, or potentially raise more capital than you have previously to cover higher interest rate costs?
That's a complicated question.
The best ones are.
So I think it's going to be a mixture of all of those things. I think rents are going to have to adjust to higher interest rate environment, but also a higher construction cost environment. So operators are going to have to wear more costs. unfortunately for them. We're also going to have to look to adjust our returns, and that might mean that ultimately our price changes or debt costs come down. And I think also the final element is that potentially construction costs are going to have to moderate, because at the moment, if you look at those three things together, it doesn't make sense for us to develop new facilities. It doesn't make sense for any of our peers to develop new facilities. And I think it's very unlikely that we're going to see no new healthcare facilities delivered over the next 5, say, years.
I'm excited to see what you do next. Thanks so much for your time, Aaron.
Thank you.
Despite the valuation write-downs and other challenges, listed property firms are all trading at discounts to their net assets. So does that make them a buy? Rohan Koreman-Smit from Forsyth Barr has his own take on the value of the sector. Hey Rohan, thanks for coming on to chat.
Thanks for having me.
Can you please explain what's happening in the commercial property sector at the moment? They're suffering from devaluation losses on their portfolios, but they're also selling assets. What's happening?
Yeah, so high interest rates have been pressuring asset values. The valuations themselves are typically pretty backwards looking. So the valuers need evidence of transactions. And we haven't had that. The COVID period was very busy, but since interest rates have gone up, transaction volumes have cratered. So they haven't had much evidence, and it's taken a while for that to come through. So we're finally seeing the revaluations that effectively the listed market had been pricing for a while. The share market typically leads the unlisted market, as it's much more forward-looking, and also from a kind of book value perspective, it kind of leads its own book values by about 12 months. So the listed market's been pricing this for a while, and now we're finally seeing it from the companies.
The average gearing ratio across the sector is just over 31%. That seems like quite a lot of debt. So how much of an impact will higher interest rates have on their finances? Yeah,
so actually they're a little bit better placed than say the GFC. Gearing's a bit lower going into this event, and it's been a slower moving kind of event, given the slow transaction environment. So the companies have had a while to respond, and they're all responding pretty appropriately. And so far, balance sheets have been pretty manageable. Assets have been sold where needed. We've seen DRPs turned on, so dividend reinvestment, and the odd one has kept a little bit more in terms of retained earnings. So you add that up, and so far it's been so good on the balance sheet side.
Is this event at all comparable to the GFC? Is it that bad?
The GFC was a very fast-moving event. This has been, I guess, a slower, more painful, more drawn-out process. The lift in interest rates, it's kind of a different cycle from that respect. GFC interest rates fell quite rapidly afterwards. We've had a rising interest rate environment. So it is quite a different playbook this time. But in terms of the impact on asset values, it's kind of broadly similar. Cap rates are rising, asset values are falling. It's all part of the property cycle, I guess.
Share prices have obviously taken a hit through the cycle. Do you think all of this is currently priced in?
Yeah, so on our estimates, there's probably about 100 basis points of cap rate expansion priced into the market, which, with the sector trading sort of 25% below book values, suggests we've got another 10 to 15% of asset value decline already priced by the listed market. So, there's still more to come, or the listed market is pricing that there's more to come. And I'd say a large part of the cycle is already priced. Never say never. We thought interest rates were plateauing and they've started to tick higher again. So, a further move up in interest rates will obviously be a negative. Stabilisation would be actually a reasonable positive because there is already a lot priced in.
You mentioned that some asset sales are happening at the moment, but how much has activity generally stalled given the interest rate environment?
Depends on how you measure it. It's actually quite a big market. If you're looking at transactions above, say, 20 million, so the larger size transactions, you were probably doing, say 100 or so at the peak, maybe a little bit over, and we're down to kind of like the low 20s. So it's quite a big fall. Things have actually picked up over the last while as vendors have become more realistic about what they can achieve, and interest rates have maybe provided a bit of support with a flattening.
The sector is pretty much split between retail, office and industrial. Which of those asset classes do you think is best placed?
Yeah, that's an interesting question. we are seeing quite different outcomes in each asset class. Industrials obviously had some really strong rental growth. Prime office is now catching up. There's a bit of demand from tenants for good office space to entice tenants back into the office. And retail sales have actually been pretty good, although the outlook is likely to slow given consumer pressures. So the best place kind of question comes down to what is in the price. Values for industrial are still very high. Office has come off a bit, and retail, given the trends it's been facing for a long time from online, is probably the lowest price sector. So, investors need to take all that into account in terms of what the assets valued at currently and the outlook for rents.
Yeah, on valuations, all of these companies are trading at a discount of as much as 30% for some of them compared to their net tangible assets. What should investors take from that? It looks on paper like they're a buy, but are they?
Yeah, that's the million-dollar question, I guess. There's a lot priced in at the moment, particularly in some names where the discounts are greater. One in particular has had some concerns around balance sheet. They've successfully executed a few asset sales, which should alleviate those market concerns. But in terms of, are they absolutely cheap? Well, I'd probably say we're probably at about fair value for current interest rates. Yes, the book values are well above, but I think there still needs to be some reasonable adjustment to those book values. We've currently got interest costs where investors raising debt to buy some of these assets need to pay 7 or 8%, and making that work from an investment basis where the yield you get on the asset is below that just is tough. And until that kind of situation normalizes, whether it's cap rates rise further or interest rates come back, then you can kind of start to get a view on whether the assets have become cheap or not. But at the moment, I'd say given the rental increases we're seeing and the cap rates implied by the listed market, they're probably about fair value.
Because it is so tough out there, what's your outlook for dividend yields? Should we expect them to grow at the rate that they previously have been?
Yeah, well, the sector's always been a slow grower, so there's always kind of 1% to 2% kind of growth from dividends. There is a lot of under-renting in portfolios, so that's where the market rent for some of these assets is actually above what the current tenants are paying. So that should help support rental growth. The obvious headwind there is that interest costs have gone up a lot. So we're forecasting pretty flat dividends for the next 3 years. That's not a bad outcome given the kind of backdrop of rising interest rates.
I always find it interesting when you're trying to pick a listed property vehicle to invest in, because they're not just like a standard listed company where you can just look at their PE ratio and that's an easy enough analysis to know if you're paying too much or too little for the stock. So what's the best measure that an investor should look at when it comes to listed property? Is it their portfolio valuation or is it occupancy and lease terms?
Yeah, so it's kind of a mix of all. You want to know the outlook for the sector. Do you expect sector rents to grow? Rents obviously drive asset values along with the multiple that you pay for that rent. You also want to know the security of the tenant covenant. Do you have a good tenant? Are they likely to pay the rent and keep continuing to pay the rent? There's gearing that you need to take into account. So you do need to take into account a number of different factors. As you do with all companies. But in terms of absolute metrics, I think the yield versus comparable yield is a good one. And a yield plus growth type metric, total return is generally kind of how we think about it as well, along with what is the actual value of the underlying portfolio kind of marked to market. But in terms of the current environment, it's quite uncertain. We're seeing big movements in asset values and there's a bit of economic volatility on the horizon. So our general advice at the moment is to own the quality names, so the better quality portfolios, and also own those that have some sort of essential service and long lease term. At the moment, that should hold up pretty well in what could be some pretty volatile economic backdrop in the next 12 or so months.
Thanks so much for your time, Ron. Nice to chat.
Thank you. Thank you for having me.
Let me know if you invest in listed property names and what you think of their current or future value. I plan to do more on this sector, so let me know if there's a particular stock you want me to look into or question that you want me to help you answer. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.